This episode is brought to you by number 42%. That's how much Bitcoin has sold off from its all-time high of just over $125,000 that it hit in October of just last year. This week's low is just around 73,000, but that's close to being taken out in this very moment. And it's not just crypto. We just watched gold and silver whipsaw violently too. A rare week where safe havens and risk assets both felt like pretty much roller coasters. Mark, the action that we've seen in metals and crypto and dollar and interest rates, I mean, they have been fast and furious. So how are you thinking about all of this right now?
And you said cross-asset volatility. Maybe break that down for us, too.
I'm thinking carefully about all of it.
I know,
Look,
metals,
I think we've
crypto.
seen huge sell-offs. One of the biggest sell-offs of all time in gold. It's over on a 3-day basis. I think that the metals trade is bull for the next month, but I don't sense we get back to highs. I sense that a lot of damage has been done very, very quickly. Momentum has started to roll over. So I sense after a bounce that the metals probably go back to the lows. Cryptocurrencies are in a very difficult spot right now. And I do believe we're in a crypto winter, a 4-year cycle, which tends to repeat. I don't sense that we're going to go down 80%. Personally, I think it's going to be capped at I think Bitcoin, in my own view, goes to 60, between probably
60.
high 50s, 60. I don't think it's going to be a straight shot. So
frustrating too,
really,
right? That's what it does.
You have to be prepared to really hold this. And many people even that use technicals get caught off guard with the sudden volatility. And you're like, wow, well, I guess I'm a hodler now. I have to stay in, right? I can't get rid of it now. But look, it's difficult. My thinking is a short-term bounce could happen to 87, 88, and then we go to 60 probably into May. And that's the time you want to have some powder dry. So crypto, it's not the end of the world. I think it will bottom probably sooner than it has in years past. Crypto will likely bottom before equities. So equities could have a larger drawdown in Q3. Whereas I think crypto very well might bottom out sometime in the spring and start to turn up again. So I have optimism, but it's really important to be patient. Don't put all your assets in one basket and diversify. Understand that we're in a very strong bear market right now. And even if we get a bounce, the path of least resistance right now remains to the downside, at least with regards to crypto. With metals, eventually I think we'll probably get back to the highs.
Eventually, though, you talked about taking out recent lows after this.
Yeah, that's right. So you bounce probably throughout February in both gold, silver, and then I think we turn down, and I think we probably take out lows, which means it could get worse. Gold might get to 3,700, 3,500. And then I sense
brutal, Jared.
we probably summer into the fall is normally a great time for the metals. The key message for the metals is that still all the pieces are in place why you still want to own metals, and that being the Fed still has potentially a lack of independence right now, even under Warsh. We just don't know what's going to happen. We don't know his communication style.
Yeah.
And obviously, when you look back over history, a change in Fed leadership is generally not a smooth time for markets.
Right.
It happened initially under Powell. You saw it under Yellen. You saw it at Bernanke. You saw it under Greenspan after 87. The normal max drawdown is about 17%. So we have to be prepared. Ironically, the thing the administration wants to do, change Fed leadership, could be the thing that honestly causes volatility that might prove problematic come the elections. And that if the market shows a lot of volatility, that could change at least the House with regards to the leadership. But getting back to crypto and gold, I'm long-term bullish, but I sense the level of spending is a difficult problem on both sides, being not willing to address it. And normally that's good for precious metals, as is cutting rates. All those things are still in place. But the volatility has reared its ugly head and likely means that between now and let's say April, May, gold, silver probably drop, and then it's time to get long again. I sense that gold goes to 67.50. Silver probably can go back to new highs, particularly with China demand coming back. I think they're very, very good.
3,700 and then wait for 100%.
These have become.
And when would this happen? Because we're hearing from like JP Morgan and others, their targets for gold are over 6,000 by year end. And you're saying, like, when would that
I think that's probably a year end. I don't look, these are very extended in their longer term cycles. We've already seen almost a 3-year rise in the metals, and everybody all of a sudden became enamored with the metals, and that happened literally right near the top within a few weeks, where everybody knew the metals were working. That's normally not the time to buy them, right? So
when one of my friends is asking me at home, guys, what do I need to know about gold? I'm like, all right, this is mainstream Wall Street coming together, and honestly, that's great.
Yeah, it always pays to look when the sentiment starts to get frothy. I think we've seen that in crypto, where it's spread to the metals, and software obviously is being hit. Now we're seeing all these, storage stocks and the semis have been red hot, and I sense that's probably the next shoe to drop in the next month. But pay attention, use trends, and diversify. I think defense, defense, defense. That's a key message for this year.
Beautiful. Happens to be our word of the day.
It works
But
out
a
just great.
quick bit here, because we have got a markets take on a classic Hollywood gab show staple, Who Wore It Better? And today's runway is all about tempo, how you play the trading game. And we've got the momentum cyclist up against the diversified golfer. On the left catwalk, the cyclist. Peak performance mode, this momentum trader hits the spotlight in a skin-tight Aero jersey with ticker symbols down the sleeves. This trader is going all out on 3, maybe 4 high-conviction breakout names. No diversification, no hedges, just max watts into a handful of rocket ships. It's pure speed, pure focus, and if one of those bets blows a tire, you're eating pavement. On the right catwalk, the diversified golfer, sustainable pace, clean polo, tailored slacks, and soft leather gloves. This portfolio has a tool for every situation. Driver for distance, wedge for precision, putter for the finish. Spreads risk across asset classes, sectors, and geographies. Never tries to hit a 300-yard chip shot. Just plays the full course with balance and lives to tee up another 18. So, Mark, in this trading environment, who's wearing it better? Is it the Momo cyclist or the diversified golfer?
Well, in the words of the Dalai Lama, Gunga Galunga. Look, I'm all in favor of golf this year, honestly. If you're going to be a cyclist, you have to favor the century ride, not the sprint, because I think that eventually momentum continues to work in all markets and will eventually get back into gear. But this is a year, I think, of consolidation, of defense, that favors those that not only can hit it long off the tee, but can putt well as well. And one wants to really favor, I think the country club, and hopefully that warm weather will be here before we know it. We hear 6 weeks, but we'll know. I think there'll be a time for momentum. This seems to me to be a time of value and not growth. And I think the cyclist is going to take, a second seat behind, those that like to play golf this year.
Just to take a step back, for those of you who maybe are hearing you for the first time, when it came to 2025, what exactly did you think it would end up, and how did it play out for your forecast?
Well,
you're making some pretty big calls.
I had a target of 66.50, so we ended up a little bit short, but we did get above that. And so I always think the targets are largely are meaningless. They're they're for the media. I know a lot of sell side analysts have to come up with targets. It's really about what is happening now and how you can use price action to be able to help you not only manage risk but forecast the future, and not necessarily go out 1, 2, 3 years and say, oh, look, I was right. So I've had some good calls. I turned bearish in late 2021, early 2022. I was fortunate to catch a pretty good downdraft into June of that year, in October, and myself along with Tom Lee have been bulls the last couple of years. But this year we said, you know what, it's time to really consider that we could get that consolidation for reasons such as tech starting to gradually wane. Leadership is changing. We're in a midterm election year. We have a new Fed governor approaching. There are all these reasons why, everybody thinks, oh, this is happening in the world. This should lead stocks down, the tariffs, and none of that ever materialized, unfortunately. Look, tariffs, you could argue if they were rolled back, that could be a tricky situation this year. And how do we compensate these countries? It would obviously be great for visibility for earnings growth, but they've really helped to trim the deficit down to like 29 billion, which I think has been a very, very good thing. So always tough to know the right answer. I always love to just tune out the news, focus on sector rotation, what's leading, what's not, and let the market tell us what it's going to do. It's giving us a very loud and clear signal right now that I think the next couple months are going to be pretty volatile.
Mark, under a minute, and you've given us tons of actionable information here. Anything we didn't cover, anything you'd like to say to the viewers in about 30, 45 seconds?
Well, I think it's important, honestly, to tune out a lot of what's going on around the world for those that think that those things really matter. And also just pay attention to the fact that earnings and or economic data rarely lead to meaningful trends in stocks as much as almost 90% of Wall Street thinks they do. You really need to concentrate on cycles, on sentiment. And we had very bearish sentiment last spring. It was very important in terms of why markets could bottom. And recently, we're starting to see the opposite. We're seeing very bullish sentiment. So it makes me a little bit more cautious to think that it's going to be a year where you sell in May and go away or whatever. I think the time this spring into the fall is going to be, volatile, but I don't think it's the end of the world. I think it's going to be opportunity for those that have dry powder, and you really want to be buying dips, I think, into the fall. The bull market should persist, I think, and continue up in the years to come. But we need that consolidation, and I think that's going to happen this year in 2026.
All right. A year of defense, just kind of rewinding it back to the beginning there. And we have seen defensive sectors on the rise here, from consumer staples to utilities to real estate to healthcare and even energy. Yes, energy can be defensive as well, especially those big ones that we were talking about. But meanwhile, speaking energy, that's where we're seeing the breakout right now. And as Mark was just telling you, he was very bullish coming into the year, and that's playing out. So we got to pay attention to that. But we also got to pay attention to the clock, because we are winding things down here at Stocks in Translation. But make sure you check out our other episodes of the video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. We'll see you next time on Stocks in Translation.